people often question, is the global reserve currency good for America? With the kind of assumption that the answer is yes. But like any country, especially one as big and dynamic as America, there's not just one America. That status basically empowers certain parts of the economy, and then it hurts others.
Welcome back to the show. Joining me this week is Lyn Alden. So many people have been requesting that I bring you back on the show. So, Lyn, thank you so much. How are you doing?
I'm good. Happy to be here as always. How are you?
I'm doing well. So much market volatility, and you're the person I've been wanting to speak with as well. So let's get right into it. First, maybe let's get everyone on the same page. You had such a fantastic newsletter, a premium report about trade deficits and capital flows. So let's first really establish, can you define what it means to be global reserve currency and why trade deficits really go hand in hand with global reserve currency status for us in this current structure of the global financial system since 1971?
Sure. So the global reserve currency means that countries around the world predominantly use the dollar, in this case, for a lot of different purposes. One is international contracts. So when units are determined for what you're going to sell oil in, or even what you're going to sell a lot of other goods in, it's often in dollars, even if it's between countries that both don't use the dollar. It's kind of like the biggest ledger that they all kind of attach to in the unit of account sense. It's also the primary funding currency, meaning that like if an entity in Europe, for example, lends money to an entity in South America somewhere, it could be a government, could be a corporation, there's a good chance it'll be in dollars. Occasionally be in euros, it could sometimes be in local currency, but often it's in dollars. Um, it's also used as a reserve asset. So because these countries around the world have liabilities, either in the contractual sense or the debt-based sense, they often also store assets in dollars. And then lastly, it's the most liquid trading unit. So, for example, if you're looking to trade between South Korean currency and Brazilian currency, instead of trading them directly, you'll often trade one to the dollar and then the dollar to the other one. So the dollar is like on one side of the vast majority of FX transactions. And so because it serves all those purposes, it's basically the biggest ledger in the world that all these different ledgers connect to at the top down sense. And so what it means is that there's extra demand for the dollar. And there's kind of a couple different levels of demand. So an emerging market currency, generally there's not a lot of external demand for it other than when you're directly interfacing with that country. Certain large developed countries have a little bit more demand for them, but not much. It's still generally when you're looking to interface with that country. Whereas the dollar, because it's the biggest, most liquid, most saleable ledger out there at the current time, is used for all these different purposes, even if you're not currently using those dollars or intending to use those dollars to buy goods or services or assets in the US. So there's this extra monetary premium for the dollar. And then the next question is, so the whole world needs dollars for all these purposes. How do they get the dollars? And the mechanism that happens is that because they all need the dollar, they're structurally and like involuntarily overvaluing the dollar. If you look at it on like a trade basis or an interest rate differential basis, there's this kind of structural bid for the dollar which overvalues it. And then what happens is that because the dollar is overvalued in the system, it becomes rather uneconomical to produce a lot of lower margin goods in the US. It's one of the most expensive places to do it, even compared to other developed peers like Germany, Japan, Singapore, whatever the case may be. It's harder to manufacture in the US, even compared to a lot of other wealthy nations. Um, and it also it boosts our import power. So Americans, because the dollar is so strong, we can travel around the world. We can buy a lot of Chinese goods. And so what that does is that kind of forces open our trade deficit. Um, because it impairs our export competitiveness and boosts our import power kind of artificially. And so what we do is we just flood dollars into the world to the tune of like a trillion a year to the rest of the world every year. And that's how they get the dollars they need to continue using the dollar as the global reserve currency. And so that's why, at least in the current system that's been in place for like 50 years or so, that's kind of why they go hand in hand. They're tied at the hip.
Coin Stories is brought to you by Genius Group, a Bitcoin treasury company listed on the NYSE under ticker GNS. Genius is on its way to hodling 1,000 Bitcoin in its treasury while educating the world on a Bitcoin first future. Genius is launching the Bitcoin Academy with courses from Safety Moose, author of the Bitcoin Standard. Join the launch waitlist via the QR code on the screen or the link in my show notes and receive the weekly Bitcoin Treasury newsletter. Genius isn't measured in IQ. It's measured in BTC. Next up, a quick word about my friends at Bitwise. They've been educating investors on Bitcoin for more than 7 years, have over $10 billion in client assets, and a team of 100 plus. Their weekly newsletter is a must read. It's written by their CIO, Matt Hogan, one of the best minds in the business. I highly recommend it. It's witty, bold, and quick. Takes just 5 minutes to read each week. So head over to bitwiseinvestments.com/CIO memo. And always, of course, carefully consider the extreme risks associated with crypto. Don't forget to join me in BTC Vegas this May and attend the 4th annual Women of Bitcoin Brunch. Use code HODL for 10% off your pass. So people basically around the world at low cost make things that they sell to us to get our dollars. And we're sort of in a position of great privilege because we can just print these paper dollars out of nothing, essentially. That's what we've been doing. So can you zero in on exactly how this has really hollowed out the working class and it has benefited certain sectors, which you talk about so brilliantly in chapter 13 of your book? Heavy is the head that wears the crown of being the global reserve currency. This has really benefited real estate, technology, high margin sectors, as well as the political forces, anyone that's close to the money printer. We've financialized the economy at the expense of the industrial base.
Right. So people often question, is the global reserve currency good for America? With the kind of assumption that the answer is yes. But like any country, especially one as big and dynamic as America, there's not just one America. It's a big mix of a lot of different things going on together that happen to be in one political entity. And so that status basically empowers certain parts of the economy, certain people in the economy, and then it hurts others. And so, for example, if you're in Washington, D.C., and you want to be able to sanction almost anyone in the world, it's nice that everyone's using your ledger. It makes it harder for any entity to go around it. Not impossible, but your sanctions are rather powerful compared to if Canada's sanctioning you, for example. Um, you get a lot of leverage that you can basically pressure other countries with. You have the rest of the world financing part of your deficits because they have this kind of structural need for assets. It's generally good for the stock market because all this capital, what countries do with it, there's often this thing that people say, well, we're sending them pieces of paper and they're sending us goods and services, which is true, but then there's one more step. With those pieces of paper, they go and buy our financial assets. So they buy our stocks, they lend to our corporations, they buy our private equity, they buy some of our real estate. So we're actually what we're doing is we're selling portions of our appreciating assets to the rest of the world, and we're acquiring some of their depreciating assets, goods and services, which are useful, but they're different than appreciating assets. So if you're in New York, if you're in the dollar export business, basically, which is a combination of Washington and New York, that's great. If you're in a high margin industry like tech, healthcare, places like that, you're maybe not super benefiting from it, but you're not really harmed by it either. You're not really, you get a lot of the privileges of having a strong dollar without a lot of the downsides. Most of the downsides hit lower margin physical industries, particularly manufacturing. That's why it's at the centerpiece. And so all these industrial towns, like basically across the Rust Belt in particular, that's why it's called the Rust Belt. It has literally
Mm-hmm.
spent decades stagnating and in many cases literally rusting because we have these like unused steel manufacturing facilities, unused heavy industry, unused light industry. It's really dwindled because there's been little reason to invest in more of that because it's not very competitive.
Mm-hmm.
And so it hollows that out. And then by extension, I mean, if you're operating a restaurant, in one of these towns. You're not in the manufacturing business, but you're in a manufacturing area or a heavy industry area. And so it's not just industry specific, it's regional specific, which is why some parts of the country have more flourished, regardless of what occupation you do, and other parts have suffered. And so the problem is, so like running a trade deficit for 1 year or a few years is not a big deal. Deficits come and go. Different countries go through these periods. The problem is that when it's structural, due to the reasons I previously described, when you have 50 years in a row of trade deficits, you get a really big imbalance. We've like stacked all the cards on like New York, Washington, Silicon Valley, basically the coastal cities, and we've really kind of kept taking from a lot of the heartland area, except for the farms. But we've taken a lot from all these industrial places, and so you get political changes, you get national security challenges when you
Yep.
realize like you're reliant on your military components to a kind of alarming degree, from foreign sources, or you realize that a country with less GDP than you can pump out missiles faster than you can, just because your manufacturing base is not disproportionately bigger than theirs, even though your economy is. So it has various implications as it builds up for decades.
Now, after 1971, when we went off the gold standard, did that exacerbate these trade deficits, or always, even if you don't back your currency with something like gold, do you have to run structural trade deficits as global reserve currency?
So there's a couple of different mechanisms that can work. Primarily, the imbalance before 1971 was the dwindling gold reserves. So we had the imbalance where dollars are ostensibly backed by gold, only for foreign official creditors, not for domestic sources and not for foreign unofficial sources. But like a foreign central bank could redeem dollars for gold. And the problem is we just kept making more dollars from a variety of different mechanisms. There was no tether connecting them to the amount of gold we had. So foreign countries kept over time redeeming them. So we went down from 20,000 tons in like a little over a decade down to like 8 or 9,000 tons. And the rate was just accelerating, especially when you get a certain crossover point where like any of these foreign entities can say, "Oh, that's completely unbacked. This is gonna, if we don't get our gold now, we're not going to get it." So it starts to become nonlinear, and so they severed the connection. They defaulted on the promise. So the kind of the primary like capital we were drawing down from to maintain that status during the Bretton Woods era was that we were shipping out our gold, and then it shifted to shipping out our industrial base. So these imbalances can take different forms depending on specifically how it's structured. And it's worth pointing out, I mean, the actual Bretton Woods system was really only in place for a little over a decade. We often think of it as the mid 40s all the way up to 1971, but for like the first half of that, there were all these like really tight capital controls and things like that. I mean, that was like the world kind of rebuilding after World War II, and a lot of those kind of left at the end of the 1950s. So from like the very late 1950s all the way to 1971, so call it 12 years. That's when all that gold depletion just very quickly happened, and the system broke in like 12 years. Now that the current kind of fiat system's been in place for 5+ decades, so it's had a longer lifespan than that, but it's built up these imbalances in different ways, which is mainly the trade balance and the industrial base situation.
And so we replace gold with essentially US treasuries. That's not just the currency we spend, to your earlier point, but really the reserve asset that all of these countries need to purchase. And so we have this demand for dollars around the world, but Trump is sort of framing this as other countries have been taking advantage of us, and he wants to change that. And these tariffs are supposed to be a way to reshore, to strengthen our industrial base, and to focus on Main Street. I'm getting the sense that these tariffs though are incompatible with our reserve currency status. Can you talk about that?
So I think in isolation they are. It's not to say that tariffs are always bad or that they couldn't be part of a potential solution. But like a lot of things in politics, this is kind of like simplified. It's harder to explain the stuff I just explained, especially because that's not even the full story. That's the highest level thing. If I was at a political rally just saying what I said, I would have like lost half the audience. They'd be sleeping. It's not very exciting. There's no, and I'm not. Who do I blame for all that? Who do I blame for 50 years of accumulated decisions,
Yeah.
right? There's no other that I can be like it's their fault. It's our gradual fault
Hmm.
over time. Everyone's fault. It's the structure of things. Um, it's much easier to say this country's screwing us over, so we're going to do this approach now. Um, and there's always a good there's always like a part truth to those types of things. So it is true that like other countries, given the system as structured, they will then do mercantilist policies often. They will tariff us while we're not tariffing them. And so that's a reality, but I would say that that's basically a layer up. That's a layer that exists. That's like a symptom. That's a layer that exists on top of that more structural issue, which is often too financially wonky to bring up in a political sense. Now, in the administration, JD Vance has brought this up. He's
Mhm.
specifically linked the global reserve currency to the trade situation and kind of openly questioned. I mean, is this the structure we want right now? Um, uh, Trump's chairman of the Council of Economic Advisors, he also has made this connection. I mean, he's a Harvard trained economist that
Stephen
kind
Myron?
of yeah, Stephen Myron.
Yeah.
He's written papers on this. He's talked about
Mhm.
this. So there are people in the administration that are able to, in certain settings at least, kind of lay out a little bit more of a broader picture. But the sound bites are generally focused on other countries taking advantage of us, whereas this is something that it's part of the system we've helped construct, and that we've been kind of collaborative with them in doing. And again, there are like so it's one thing I see in politics right now is like on the left, for example, some of them are saying that trade deficits don't really matter. That's not a big deal. That we're getting stuff out of it. So I would push back on that too and say, sure, certain trade deficits don't matter, but 5 decades of them do, right? So
Right.
I think it is right for I think there is a political mandate now to go after the trade deficits. I think we saw that. I think that's part of the reason the blue wall became like a red wall in the
Mhm.
electoral map, because those industrial bases have swung. They used to be historically blue. Um, Year after year, they're not really like they're just still structurally impaired. So there's been a political realignment, and I think it is powerful to elevate trade deficits, but then it becomes a question of is the strategy executing well or not, or is it being described correctly? More so than is it the right thing to address? Because I think it is the right thing to address.
Okay, so that leads me to my next question. You brought up Stephen Myron, JD Vance. It seems like the administration is recognizing that the global reserve currency status is maybe not benefiting us as much as it used to, and they do want to focus on Main Street. So, did Trump, in a way, effectively start to close the dollar window while at the same time he campaigned on the fact that he does want the dollar to be the global reserve currency? Like, is there some sort of plan in motion, you think?
I think so. That's one of the criticisms I would have. And I don't really wade into politics other than when I'm talking about finance. I mean, I'm not trying to be partisan. I'm always just trying to analyze any given problem. Um, I think an issue is that in the administration there are multiple camps, um, and some of them are. So one of the promises of the GOP 2024 campaign was preserve the dollar as the global reserve currency. In
Yes.
addition, we've had Secretary Bessent often talk about we
Mhm.
want to have a strong dollar policy. Uh, uh, it's not good optically to say you don't want to be the reserve currency anymore, or that you want a weaker dollar. Imagine anyone in the Trump administration using the word weak to describe something they want. It's just not. It's not
Yeah.
on brand. So
Yeah.
they often phrase things like we want other currencies to trade at their appropriate valuations, or we don't want them artificially submerging their currency compared to like, there's different ways that things can be phrased. But I think one of the challenges is that there are different parts in the administration that as a whole they want their cake and eat it too. They want their global reserve currency, but they also don't want the trade deficits, and the plans so far don't really make that possible, in a sense. The other point I would point out is that being the global reserve currency is not like a Boolean outcome. It's not like you either are or aren't. That's how it
Mhm.
is in the current era, but there's no fundamental reason it has to operate like that.
Yes.
And one thing I've been arguing for years, in some of my articles, is that the world's gotten so big that no one currency can really serve the role of the global reserve currency without disproportionate imbalances kind of impairing the whole thing, which is what we're seeing. Basically, the United States at 15% of global purchasing power GDP and 20 to 25% of global nominal GDP, and like 4 or 5% of
Mhm.
the global population, just isn't really, even though it's huge, it's not big enough to really be serving its ledger to the rest of the world to use as like their main ledger. But neither is China, neither is Europe.
Right.
There's no fiat currency entity big enough for this purpose. So one of the solutions is a more multipolar world, where you say, well, maybe you can use more Chinese currency for the main funding currency in the East. Um, we've already seen obviously more entities use the euro in Europe, and
Mhm.
you could maybe broaden that to around Europe, and then the dollar remains dominant for a long time in our hemisphere. So there are solutions for that. Trump has pushed back on, like he says, if they make a BRICS currency, we're going to go after it. No, I don't think the idea of a BRICS currency makes sense. Um, but just the idea that they don't want competitors for the currency, but they don't
Mhm.
want the trade deficit. um, there are trade-offs in life, basically.
Yeah, exactly. I mean, it seems like the right way to execute this would actually be to import first cheaply all the things that we need to actually build up our industrial base again, the factories, the infrastructure. We don't have any of those things that actually would make our capital goods here, right? And that's a many year process. And so I would think that they would maybe devalue the debt first, go after all of these things, start making things here, and then maybe increase tariffs and move in the direction of diversifying FX reserves, or maybe potentially go back to something like gold. I know you follow Luke Roman's work closely. We just did an interview, and one thing that he's suggesting is that they're actually doing some of this on purpose so that they could send gold up and then revalue the gold at the current market levels much higher than even they are now, and then be able to use that to pay off some of the debt. Do you agree with him?
I'm not sure how much I describe to purpose. I would say that's happening. I think basically, so I love Luke's work. I think elevating neutral reserve assets in addition to the multipolar currency world is what can alleviate this structural imbalance. And basically, those neutral reserve assets serve as the glue that ties those multipolar currencies together. That's basically the window, the structure that connects them all. So I do think that boosting the size of those neutral reserve assets is one of the ways out of this. That's one of the steps that goes along with making these imbalances stop, and that kind of comes along with basically reducing the use of the treasury as the primary reserve asset. Um, there's a lot of folks in the treasury. It's also the stock market. So I mean, like Switzerland central bank buys U.S. stocks, sovereign wealth funds around the world buy U.S. stocks, large private pensions around the world and large pools of capital buy U.S. stocks. So it's financial assets as a whole, with treasuries being the most popular at the central bank level, but that's only a piece of it. Um, and so I'm not sure I would describe a lot of planning, um, because I think he made a similar argument in the prior administration that when us in Europe like sanctioned Russia, that was a tool chest to kind of push the rest of the world toward gold and things like that. So you'd have that planning then across two very different administrations in that sense, with a lot of moving parts in play. So I think that there are probably entities in both administrations that might view that as a strategy. I'm not sure if that was the highest level strategy as a whole, but I'm not a political analyst. I have to
Mhm.
monitor actions more so than
Yeah.
intentions. So I look at words, I look at actions. I care less so about intentions other than where possible.
Right. The outcomes are really important. I agree with you. I'm having trouble um, understanding what to really believe because their statements are contradictory to what they've been doing, including when Besant criticized Yellen for issuing all the debt on the short end. And then basically he came in and has been doing the same thing. He said that they're not going to revalue gold, but some of the decisions they're making now with these policies, it seems like will have to move in that direction. So it is really confusing. Turning to the macro, I mean, the reaction to these tariffs and the market volatility, can you talk about the aspects that have been really unprecedented, where not only the risk on assets have been selling off, but also all of a sudden bond yields spiked, which seems to be the opposite of what they wanted to happen.
Yeah, so the U.S. Is experiencing something that's very rare for the U.S., but it's common among emerging markets, which is capital outflows. So often when we see stocks going down, it means that investors are selling stocks on average, and then they're plowing into other U.S. assets like stocks or like bonds or cash. Um, and sometimes the rest of the world's doing that too. So generally, when stocks are going down, it's usually pretty good for the dollar index, and it's usually pretty good for bonds, meaning bond prices up, bond yields down. What we saw during this recent market turmoil is that as stocks were falling, bond prices were also falling, meaning that their yields were going up, and the dollar was weakening in many days, which is a sign of a capital outflow. It's a sign that foreign capital, um, either strategically or just as a market thing, said, I it could be an entity like China saying I want to impair them a little bit, so maybe I want to trim some treasuries to send a message. It could be you're just a fund somewhere in the world and you say there's a non-zero risk of my capital there now. I want to pull some of it back. I want to repatriate some of it. So for whatever the reason, there's probably a bunch of reasons, some foreign capital has pulled out, which and to Luke's point, he's been talking about that risk for a while. That's a well-known thing, um, and so that's what made the market so unusual. And the administration they explicitly want to get the 10-year lower. Um, and despite increased odds of a recession and despite choppy stock market performance, which would normally be a good environment for getting the 10-year lower, they've not really been able to. Um, and that goes back to my other thing I focus on is fiscal deficits too, that there's very large fiscal
Hmm.
deficits. I would also say that they had a really good environment to get it down because they currently have the debt ceiling in place, meaning that they're not really even issuing net new debt. And the Treasury is actually drawing down its cash reserves,
The
which is,
TGA.
yeah, the TGA. So imagine if they were doing this while they were not drawing down the TGA or if they were even refilling the TGA. And so
That would
they still,
suck liquidity out, right? That would
yeah,
exacerbate it.
yeah, that'd be basically so when they're drawing down the TGA, it means they're spending money that they've already borrowed, and that's pretty good for liquidity. When they're refilling the TGA, they're borrowing money without spending it, so they're sucking
Hmm.
money out of the system around the margins to the tune of a few $100 billion at least into this kind of like government void that sits there until they spend it again. And so, despite somewhat favorable conditions, the 10 year has been pretty choppy.
This episode is brought to you by Casa, the leader in Bitcoin self custody solutions, helping people like me secure their wealth with simple, powerful, multi key vaults. And now Casa is here to help businesses and even governments do the same. Introducing Casa Business, a secure, easy to use 3 key vault designed for small and large businesses with team signing capabilities and a web dashboard. Start your Bitcoin treasury the secure way and protect your assets. Get 10% off your Casa plan at casa.io/Natalie. If you use Bitcoin, you need a wallet that's fast, simple, and packed with features. That's why I love Speed Wallet. Send and receive Bitcoin or swap Bitcoin and stablecoins instantly. Shop gift cards, play games to earn Bitcoin, and explore mini apps. Download Speed via the QR code on the screen or the link in my show notes and use referral code CoinStories10 for 5,000 free sats. Next up, the Bitcoin way. Bitcoin is only freedom money if you control it fully. The Bitcoin Way can help you learn the skills to properly secure your Bitcoin in 100% self custody with zero counterparty risk. Go to thebitcoinway.com/Natalie to speak one on one with the best experts. Your security and sovereignty are priceless, so don't gamble with your future and peace of mind. So, how do you see this playing out? Where do you think this is going to go? Some people are worried that we're going to crash harder. They're going to need a pivot, lower interest rates, start printing again, maybe yield curve control. What do you think?
So I think that the hard part of that is that I have to break it up into if else because it partially depends on what they're going to do with tariffs. And these headlines change sometimes hour by hour, sometimes day
Yeah.
by day, which is okay, all these countries are tariffed, and then it's like, okay, most of them are only lightly tariffed. Instead, we're going to double up on China, but then we're going to exclude certain things because we actually don't want the consequences of 145% tariffs on China. Some of the recent headlines is that farmers are saying, well, my all my contracts for like soybeans are going to be impaired going to China. Um, so in the prior Trump administration, they had to bail out the farmers
Right.
because they had a much smaller version of what's happening now that did
Mhm.
impact farmers. So a lot of these farmers are saying they need another bailout. So partially, it starts with what's going to happen in the coming weeks with, say, these 145% Chinese tariffs and the exemptions and things like that. Um, I think we're going to probably see some rerouting, which is to say that some Chinese goods can go to other countries and then go to us. And then it depends on how much the administration wants to block that from happening or kind of let it happen, knowing that at least it's kind of going around it for now and gives more negotiating time. Um, that's the thing. It's partially dependent on what the administration is going to do. There are ways out of this that I think that they can optically benefit from. I mean, for example, the prior two major currency accords, Bretton Woods and Plaza Accord, were named after the hotel that they occurred in. Um, and if you had an accord today, it would almost certainly take place in Mar-a-Lago. So
Mhm.
he could have his hotel attached to a historical event currency accord. Um, there's also like in the Stephen Myron paper, they talked about other ways of going about this. He kind of presented multiple solutions. One of the solutions is that instead of going after the tariff side, you go after the reserve asset side, which is to
Mhm.
say you start discouraging excess foreign buying of your financial assets. So your treasuries, your stock market, your bond market, things like that. Um, it's also optically hard to do that because you like what politician is going to come out and say we want
Yeah.
foreigners to buy less of our assets? Because
Right.
the media answers, well, why? And then you have to go back and be like, well, read chapter 13 of Broken Money and like the whole thing we just talked about, this big wonky
Yeah.
description of these like decades of imbalances and why all that structural foreign bid for US assets artificially inflates the dollar and causes these things. So, but I think that like if you kind of if I put on my like wonky hat of how I would if if I were advising them, probably one of the things would be, start discouraging that excessive accumulation of U.S. assets. If anything, be an ally of foreign attempts to build other currency blocks. So basically, China, go ahead. If you're going to do deals with South Korea, do it in your currency for all we care. That it's great. It means it's like there's less like usage of the dollar that's kind of imbalancing us. Fine, and things like that. So basically saying, okay, multipolar currency world's fine. We don't want excessive foreign buying of our assets, especially if it's impairing our ability to have our own industrial base. Um, and you can get a bunch of major currencies, political leaders together, but basically a bunch of their treasury secretaries, their ministers of finance in Mar-a-Lago, and say, let's have a plan here for how we can do this smooth and start impairing some of these, I mean, changing some of these imbalances.
Hmm.
And I think it comes with the acknowledgement that this is a 50-year problem, and that you need to start making changes. But these changes don't happen overnight. It takes years to build manufacturing facilities. It takes years to ramp up heavy industry. Heavy industry in particular needs a lot of energy, so you have to ramp up energy
Yes.
infrastructure, supply
Hmm.
chains that are very interconnected and have to gradually move. There's also the human capital element. So in any place that specializes in something, it means there's a lot of specialists in it. So, for
Yeah.
example, Silicon Valley has a really big network of not just startup people, but also the whole ecosystem around supporting, startup companies, all the financing networks,
Yeah.
all the experience. China has these really big manufacturing hubs, just
Hmm.
countless experienced technicians and people that run factories and know all the supply chains and have all the relationships. The U.S., we basically told students for decades now, don't go into making things. Go into
Right.
Wall Street, go into healthcare, go into tech. We very much implicitly discourage going into manufacturing. We don't really have the human capital. When Taiwan Semi was building some of their facilities here, there was controversy because they were like looking to fly in some people from Taiwan to fill in the gaps that they had trouble hiring in the US because the certain human capital just wasn't built up. And that takes a while. That takes retraining. That takes
Yeah.
a generation of students wanting to go into this work. So I
Right.
think I would start with the premise that we're pivoting the change, but then it's gonna take a while. And ideally, you want to do it in a way that's smooth, but
Right.
we'll see.
I think if you ask the average American if we should be the global reserve currency, they would say yes. You know that they think that that benefits them, and telling them that we're moving away from that would arguably scare them. But what message do you have about maybe the idea of becoming a more multipolar world, returning to a neutral reserve asset? How would that really impact Main Street or the working class? Could we see a resurgence of what used to be the backbone of America?
Yeah, I think you could. I think, I mean, if it's not great for Washington and New York, but it's good for the industrial places of the country. Um, and ironically, it can get so bad that can even be good for Washington and New York because, for decades it's been good for Washington and New York, but that only matters until it's gotten so imbalanced that you either have rising political populism, uh, an industrial base that's so impaired that it's even weak for national security and things like that. So basically, it's good for one side, bad for the other side, until it gets to such an extreme degree that it's kind of bad for everyone.
Yeah.
Um, and so there's kind of this mutual benefit of, hey, we have to not have this be so imbalanced. And Secretary Percent, he had a good point, which was, we'll see if it's true or not, but I think the phrasing was good, which is the next 4 years are for Main Street, not for Wall Street. Like, so Wall Street spent all this
Yeah.
time winning. We don't want them to lose, but the next 4 years are focusing on Main Street. I think that's good messaging, for example. Um, and I also, in the book, I use America the Empire versus America the country, which is to
Yes.
say, part of why we are so hardwired to think it's good for the dollar to be the global reserve currency, like the only global reserve currency, is partially because our political leaders tell us this, and for decades, the one that benefit from that are our political leaders.
Mhm.
So, like, if you um, care about America being able to maintain its 800 foreign military bases, if you care about our ability to sanction any other country, then sure, the dollar as the global reserve currency is really powerful, at least until it impairs our industrial base to this degree. But if you're an industrialist, if you're a farmer, if you're if you do a lot of jobs in the United States, you want a stable currency, but you don't really directly benefit from your country's currency being the primary ledger that all these imbalances get pushed on, which means that they bid up our financial assets, but then they impair our ability to make things here. So, but I think that's part of the challenge. It's why I sympathize with the administration and why they have some of these conflicting signals because it's not easy
Yeah.
to articulate. It's really
Hmm.
the optics of articulating it are very challenging, especially because we've had decades and decades of one narrative that global reserve currency is a good thing as structured. It doesn't really come with any cost. And this is not true. So it takes time to kind of explain that relationship and then explore a more balanced world.
I think I still have a hard time understanding how you isolate Main Street if you crush Wall Street because people's 401ks are getting crushed. We're seeing farmers and other workers really upset about these tariffs and these viral political rallies. People, even Trump supporters, getting very upset about the current climate. So
Yep.
how do you really isolate the two and say, hey, you know what, Wall Street, you've done well for these last few years. You hold on a second, enjoy your earnings that you've had. We're going to focus on building up Main Street. I feel like they're so interconnected.
In short, this is why I didn't go into politics because I don't sympathize with anyone who has to deal with this for the next decade because there's almost no world where this transition happens without pain, um, which is because there's so much global capital stuffed into U.S. equity markets, they and at least until this recent correction, it's somewhat still they're somewhat overvalued, and so if you don't own financial assets, you don't really care if they come down.
Yeah.
But if you're middle class or up, generally you have 401ks, you have pensions, you directly or indirectly care about the performance of the stock market, and
Hmm.
yet you also care about the industrial base being hollowed out. But all that foreign capital that's hollowing out our industrial base is the things that are like buying our stocks.
Right.
And if you look at stock ownership in the U.S. over the past 50 years, it's increasingly foreign. Like,
Hmm.
it used to be, large domestic pools of capital. It's still majority domestic, but the foreign share gradually grows over time because that's where a lot of those trade deficits get recycled into doing. So
Hmm.
there's kind of three camps here. There's one camp where the person's almost entirely on the side that benefits from the current system. Uh, you work in finance, you work in, certain things like this. Like you're just very much on the side of status quo is great. Then there's the other side of the spectrum, which is that you're from an industrial town. You don't really have a 401k, or if you do, it's small. Your kind of income's been more impaired than you gained from any sort of stock market or lose from any stock market turmoil. So you're
Hmm.
generally on the side that probably would want this to switch sooner rather than later. Most Americans probably find themselves somewhere in the middle, which is that they're directly or indirectly kind of harmed by the trade deficits and the ramifications to come with that, the unstable politics and things like that, all these kind of things that grow, the opium epidemic, and basically all these
Hmm.
kind of symptoms of this. But they also have a 401k. They like taking foreign vacations with a strong dollar. They like, all the benefits that come from it. So there, a lot of Americans, it would be a pro and a con. You might have a poor 5 to 10 year period of stock market returns. You'd have a period of higher inflation probably if this gets realigned because the strong dollar is disinflationary as a variable. Um, but it's kind of part of rebuilding the industrial base, and it's kind of part of paying for things that have already happened. It's not really a
Hmm.
choice at this point. It's kind of another way to describe it is that you can either push this as long as you go and then let the change happen to you involuntarily, or you can kind of recognize it in advance and gradually start changing some of these pieces where there are costs to doing it. But it's better than waiting and have it happen all at once. It's kind of like eating healthy is not always fun,
Yeah.
but we want to if we don't want the symptoms that come later.
Yeah, and real change does take time. I did want to ask you about real estate because I have seen some analysts predicting a massive unwind and so many properties overvalued. A lot of people that took on Airbnbs thinking that would be a great investment, those are selling off. FHA delinquencies are up. Are you nervous at all about the real estate market and how unaffordable it's become for a lot of people?
So I would separate this into a couple different problems. One thing that's interesting is that while the U.S. The most of the imbalances that we just talked about show up in our stock market and our liquid capital markets, there are some areas in the world, like parts of Australia and Canada, and parts of Europe as well, where the imbalances show up in their real estate market. So
Mm,
like a ton of Chinese buyers will come in and just be part of the structural bid for why those properties are so expensive. So those bubbles are pretty frightening compared to the
mm,
valuations we see in most of the U.S. So the U.S. we don't have the highest property valuations by a long stretch
mm.
because that's not where the imbalances really show up. They show up in our stock market, other liquid markets. So at least we don't have that specific issue. Um, we do have the issue where a lot of the real estate market is based on 40 years of declining interest rates and ever higher real
Mhm.
estate valuations. That's had negatives too because it's great if you bought your home in the 70s or 80s and enjoyed all that appreciation with a fixed mortgage attached to it. You could keep refinancing. It's bad if you're younger and you want to buy a home because the house to income ratio is so high right now.
Yep.
I do find that highly concerning. Um, I think that basically as we go through this period, we don't have any structurally falling interest rates. It is going to put downward pressure on the real estate market. That's somewhat balanced by the fact that we're still running very high fiscal deficits.
Mhm.
So there's still all these currency units basically pouring into the system. So we have to be mindful of what unit of account you're comparing that to. Um, I do think we'll see higher default rates. No, I would not want to work in as a real estate agent right now. It's just like much like I wouldn't want to run for politics right now. There are certain things
Yeah.
that so I would certainly feel if I was in that industry, and for those watching, it could be rough. So it's not that I wouldn't describe myself as worried about that per se, but there are certain pockets where it's very worrying,
Mm.
whether it's commercial real estate, whether it's residential real estate. I do think that's going to be a less structurally booming place to be for 5, 10 years, especially as we go through some degree of realignment.
I saw this video go viral, and it was AI generated where it's essentially Americans working in like a sweatshop factory sewing something. And there were a lot of really passionate reactions to it. A lot of people, it was a very negative kind of video. And I just don't see us reshoring and becoming the factory of the world again. I feel like if there are going to be factories here, it'll be computer or like robots. It'll be robot workers and automated work. Do you agree, or what do you think reshoring actually looks like? Because American workers are going to be too expensive to hire. Much less could you find anyone that has the training or the desire to sit in a factory all day the way that you really see in a lot of other countries.
Yeah, that's and kind of the funny point that went along with those videos is basically everybody wants manufacturing back in the U.S., but not many people want to work in manufacturing, right?
Right.
So I agree with you that most of it would be automated. There's also certain industries are just more realistic than others. So, for example, bringing textiles back, like the lowest margin stuff, it doesn't make a ton of sense to make it here.
Mhm.
So there's some degree of this. It makes sense for whatever is like cheapest and lowest margin to gravitate toward the cheapest markets. So some of those things aren't even made in China anymore because China's gotten so wealthy that it's easier to push that somewhere else, just economically. Um, and so no, I don't picture like this big like huge factory of like rows and rows of Americans making socks.
Right.
That's just not something that economically is going to happen in the developed world, let alone the U.S. The other factor is that U.S. healthcare is the highest per capita in the world, which is a layer on top of this whole thing. So that's not helpful. Um, so I think that the main thing is a lot of the reshoring that'll happen, to the extent that it does happen, will be automated. That still
Mhm.
means skilled technicians. That still means supply chain experts, people that are facilitating a lot of this. So there are skilled jobs there, um, and there are some physical jobs there. So I think it's good for skilled blue collar labor to some extent, to the extent that this actually occurs. There's also heavy industry. So if we want to, have more sovereignty over our own steel making capacity and other kind of heavy industries, again, there are still skilled workers at those places. It's very automated, but there's still people assembling it, overseeing it, fixing it. Um, Again, dealing with all the complex supply chain stuff that happens between them. So there are jobs involved, um, but maybe fewer than people think. And then the question is, if there were more than people think, would they even want that? Because
Yeah.
also the economics of automation depend on where you are. If you're doing something in a high cost area, you're going to automate every single thing you possibly can because Americans with their healthcare and salaries just super expensive. Whereas if you're operating in a more impoverished country, um,
Hmm.
you're more likely to say, well, automation is actually kind of expensive compared to paying $1 an hour
Yeah.
to have a bunch of people, do this. So
Right.
um, as it gravitates to higher, more expensive places, you automate more.
Well, for decades, if you wanted to make money, you pivoted to a career in finance or real estate. Young people chose those as their college degrees. What do you think it will be in the future? Because arguably things like code are going to be replaced by AI. Maybe we will be less financialized. What do you think young people should be looking at, or parents that have children? Like, what should people be studying so that they do have stability and economic security in the future?
It's a really good question. I think one is just well-roundedness, which is the ability to learn, the ability to be widely educated so that you can pivot toward different things as we navigate like a potentially pretty powerful transitional period. The other thing I kind of emphasize is, again, skilled blue-collar labor, especially types that happen outside of designated facilities. So we've actually seen somewhat of a resurgence in salaries for things like electricians, plumbers,
Yeah.
um, like a transmission electrician, so the ones that are working on the really big, tall, high voltage stuff that goes across the country, all these things, um, because the power of that is it's one of the hardest things to automate because
Yeah.
automation is always easier in controlled environments. It's easy to have like this robotic arm that helps make stuff, and maybe once a quarter it needs maintenance or it runs into an edge case that people have to help solve. Whereas the idea of a robot coming out to your home, fixing your HVAC system, and then leaving, that is and like you know driving correctly,
Right.
interfacing with the customer, worrying about the dog that's now like attacking them, like every single edge case you can imagine, right? That's a very hard thing to automate. Also, it's harder to put whenever you're making something portable. There's
Yeah.
tougher energy requirements. Just everything has to be compact.
Hmm.
So any sort of like mobile, skilled, blue collar work, I think that's people are suited for different things. They have interest in different things, especially because a lot of those things come with lower debt or no debt, student debt in many cases.
Yeah.
People can start their experience and their income earlier, um, and just various fields that interest people. But I think it's going to be a moving target for a while as we kind of go through this period where AI kind of eats some white collar work. We don't maybe
Hmm.
know yet what proportion because it's hard to predict exactly how quickly it'll progress. But it should be assumed that at least a lot of these kind of repetitive white collar jobs are prone to automation, and that
Right.
people, if anything, become more like managers of AI tools rather than necessarily the ones doing things directly.
Right. Yeah. It's interesting to think about what jobs are really AI proof. I want to finish up with a little bit about Bitcoin. How does Bitcoin fit into all of this? And do you think that Bitcoin will be one of those neutral reserve assets that we maybe start to position ourselves in the direction of?
So I do. I think so right now in the existing framework, gold is the primary neutral reserve assets that central banks already own. They already know how to buy. So that gets kind of the initial benefit. Bitcoin is the up and comer. So as long as it continues to stay decentralized and secure, I think it'll continue to grow in size. It has the benefit that it has its own settlement network attached to it. It's kind of the half the point. Whereas the reason gold can't kind of by itself be the best global reserve asset
Mhm.
is because then you need this like layer of credit on top of it. Whereas Bitcoin can function on its own. In addition, when we've seen these other countries try to go around the dollar, they're always trying to build these like systems to interface with each other. So all these like closed systems, trying to figure out how to do cross-border trade. While there's this really powerful open source solution kind of staring them in the face. Now, it is understandable that they've not rushed to it because using the Bitcoin network means owning volatile Bitcoin. It's also still fairly small compared to the scale that the world would need for something like this. So there's some degree of career risk of being early, for example, but it is kind of reaching the scale where I think that countries will increasingly take it seriously. Um, and so both as a neutral reserve asset and as a global settlement network, that's very powerful. In addition, all the existing things already has. Basically, if you're in a place that's authoritarian, individuals can benefit from Bitcoin as well, rather than just countries at the sovereign level. So the kind of the full stack and down, I think is pretty powerful. And then in addition, we just talked about AI. It's hard for AI to get bank accounts. It's
Hmm.
easier for them to spin up a wallet. And so I think that it makes sense that Bitcoin is a powerful tool for AI agents in the future as well, microtransactions, things like that. In addition, there's also like a lot of kind of existing software, when they face things like credit card fraud, where you pay for their services and then cancel, get your money back. They didn't really lose much by giving you that service temporarily because it's a high margin business.
Hmm.
Whereas AI services are pretty hardware based. They actually incurred a cost.
Yeah.
And so they have a higher stakes in avoiding things like chargebacks and fraud and things like that. And one
Hmm.
of the advantages that Bitcoin is at least done certain ways, it's final, um,
Hmm.
which matters more for certain types of payments than others. So I think that Bitcoin fits in multiple ways into this vision of the future.
So, what's your outlook, at least in the near term? I would assume more volatility. Maybe Bitcoin will get choppy and even temporarily slide back. I don't know how low you think it could possibly go, but do you think we'll finish the year higher than what we started at?
I'd have to remember exactly where we started the year. I know the ballpark where we started the year. My guess is that we end up higher at the end of the year than we are now, at least. Um, there's a lot of variables that could affect that. So I think that any most days where you have a big down day in markets, it's probably not going to be a good day for Bitcoin, just because most pools of capital treat it as a risk-on asset. It's still small, it's still volatile, um, and a lot of times, especially because it trades 24/7, if people are worried about how things are going to open on Monday, some pools of capital can sell their Bitcoin on a Sunday, and prepare, right? So the 24/7 can sometimes add to its volatile pricing, especially when TradFi markets are freaking out. Because we're talking about like a sub $2 trillion network compared to this like multi-hundred
Right.
trillion dollar global behemoth of interconnected finance and leverage. So Bitcoin, I think, will get shoved around by volatility. As this kind of settles a little bit, if you do get ongoing capital outflows of the U.S., that actually could be good for Bitcoin. So sometimes people ask, what could make Bitcoin more meaningfully disconnect from the Nasdaq? Well, one is anything that hurts Nasdaq margins, but that does not hurt global liquidity,
Hmm.
which should generally be somewhat supportive of Bitcoin, minus certain particularly volatile periods. But then it more structurally impairs the Nasdaq, the S&P 500. We saw similar to this in the closest period to maybe look at or study is the 2003 to 2007 period. Um, that was the prior weaker dollar cycle. There wasn't this kind of like mass excess of capital, but there was around the margins. Capital went to emerging markets, capital went to commodities, capital went to gold, capital went to these other assets. And so US stocks were not really the place to be, and a lot of other assets were. And I think if we encounter like a 5 year period like that again, that could be a period where Bitcoin does pretty well, even as the stock market, the US stock market, doesn't do particularly well. So that's kind of how I view it. I think volatile but favorable.
Well, we started the year around 93, 94,000. Are we still in a bull run, Lynn?
I Short answer is I think longer term, yeah. I think that Bitcoiners got very attached to cycles, and I think especially as the asset gets larger, those cycles become less clear. Anytime a lot of market participants think they know how something works is when it tends to change. So
Yeah.
just when all like TradFi market participants were like, well, bonds always go up when stocks go down. As soon as they all know
Hmm.
that, that's when it stops happening.
Yeah.
Because it's already fully positioned for, and then it's not going to happen. And so I think that basically everyone's seen the Bitcoin cycle so many times. They expect there to be a cycle, and cycles can change. And so I think it's less about the halving cycle. It's more about the liquidity cycle, but liquidity is complex in this environment. Um, we've at least taken off some tail risks of politics for the next few years. So Bitcoin has always had kind of this like embedded
Right.
probability of like, what if the US takes its gloves off and just goes after Bitcoin really hard, right?
Hmm.
Because that would certainly, tell every major financial institution in the US that you can't custody your own Bitcoin.
Hmm.
Um, kind of go after it. That's at least off the table for a while. So I think that a lot
Hmm.
of the fundamentals look pretty good at the current time. So I expect pretty good performance over the next year or two. But it is subject to not having like a 30% market crash or things like that that could, temporarily push us lower that we'd have to then rebuild from.
So, what do you think about those out there making price predictions literally for the next year that are 200, 250,000, 444,000? I mean, that seems out of reach for me.
The higher you go, the more I'd call it out of reach. I'm always hesitant to say Bitcoin can't do something. Like when we were at I was at the New York Stock Exchange with it was Michael Green, Nick Carter, and another, and we were asked like, could Bitcoin reach 100,000 by the end of the year? And my view, and it was nowhere near
This
at the
was
time.
last year.
Yeah, this was last year. This is 2024, and I think it was at the time of the conference. It was like probably the upper 60s,
Uh-huh.
60 some thousand. And I was like, well, it wouldn't be my base case, but Bitcoin can do Bitcoin things.
Hmm.
And it did. It touched 100K by in a fairly short period of time. It jumped from the
Yeah.
60s all the way up to 100K. So I don't really rule out Bitcoin ever doubling in a year. I mean, it's
Hmm.
Bitcoin. Um, but I tend to have more conservative price predictions, which I think there's a good chance we can get back up above 100 this year. Um, you know, Before all this kind of tariff kerfuffle, I would have,
Kerfuffle. Yeah.
yeah, kerfuffle. I would have had a higher, I would have had probably a higher price target. Um, if I imagine a scenario that brings us to very high prices this calendar year, it would probably be because some massive liquidity unlock happened. Like, let's say
Hmm.
the U.S. bond market broke, the Fed came in and like basically did yield curve control or like kind of QE that they don't really want to be doing,
Hmm.
or some sort of big treasury operation twist sort of thing. It would probably take something like that combined with some sort of like de-escalation of tariffs. So I never really rule out what Bitcoin's doing. I look at a couple of things. One is I think liquidity is probably going to be somewhat favorable for the rest of the year. And two, if you look at certain valuation metrics, I like to look at the market cap to realized cap ratio, which is market capitalization compared to the
Yeah.
average on-chain cost basis. And this current consolidation has taken off a lot of the hype around it. So if you look at the prior consolidation, so Bitcoin reached 73,000 in March 2024, um, that ratio got a little bit elevated. So it wasn't elevated to the point of like prior like multi-year tops, but it was a little bit heated. And so
Mhm.
after about a 7 month consolidation, it pretty much worked off all of that excessive valuation,
Mhm.
that excessive hype, kind of allowed the market to consolidate. Then when it jumped to like, 108K, it kind of reached similar frothy levels. And so
Mhm.
the fact that we've been consolidating for several months, not particularly surprising. I think we worked off a lot of that valuation already. So I think we're at a pretty strong foundation to at least start building from, especially once we get past maybe near-term stock market shocks and things like that.
That's right. Well, thank you so much for that. It's always so great to talk to you, Lynn. I really do hope everyone reads your report. Subscribe to her newsletter. It's absolutely fantastic. Any final thoughts or takeaways?
I think we covered a lot. I think the problem there's a lot of moving parts. I would invite people that if they're confused, um, like do more research on it because we're in an environment of talking points. So when people kind of find themselves in an echo chamber, they listen to a certain point, and then echo chamber on another side, they listen to another point. And this is actually a pretty complicated problem, and it's
Yeah.
spanned, longer than either of us have been alive. And so we're talking 50 plus years, multiple administrations, multiple countries involved, economic realities involved. And so this is like a really challenging thing to untangle. And I think it helps when more people are nuanced about it.
Hmm.
And so I just invite people to really explore some of these relationships. If something was confusing, watch the interview again. You mentioned chapter 13 of Broken Money tries to break some of it down. But there are a lot of resources out there, and there are people kind of trying to provide education in what we all hope is an objective way, and kind of work together to see what the options are here.
Yeah, that's really good advice. Nothing's black and white. There are so many grays, and so much uncertainty. But I think it's because a lot of people just aren't looking at maybe that other side and challenging their own belief system. So thank you so much, Lyn. I will link all of your work in the show notes, and hopefully I'll have you back soon. And I'll see you in Las Vegas.
Looking forward to it.
Thank you so much for checking out this episode of Coin Stories. Make sure you're subscribed to the show so you don't miss any new episodes. If you can, turn on those notifications and leave us a positive review. They really help the show grow organically with new listeners. We have a free weekly newsletter. Sign up at thenewsblock.substack.com. This show is for educational and entertainment purposes only. Nothing should constitute as official investment advice, and you should always do your own research. I'm always open to feedback and guest suggestions, so please feel free to reach out at info@talkingbitcoin.com. I'll see you next time.